Good afternoon, Orange family. Good afternoon to all my visitors, to everyone. Thank you for coming by and being here with us on this beautiful Friday. Today, we are going to talk about the difference with FHA and conventional loans. Today, I am here, Daniel Gonzalez. For those who haven't joined us ever, this is the Elite Realty Live that we do every Friday. Back to the subject at hand, we're going to go ahead and dive right into it. So, where to start? FHA, we'll start there, is what most people refer to as the first-time homebuyer loan, right? It really stands for the Fair Housing Administration loan, right? It's not necessarily what I would say is necessary or the go-to first-time homebuyer loan, mainly because there's many ways that first-time homebuyers can go about obtaining their program, right? There's many types of programs and variations as to how you can go about obtaining those programs. That said, the FHA loan is great though in the sense that, starting with the pros, you get what is called a higher DTI ratio, right? With FHA loans, you can go as high as, depending on the lender, 57% as a DTI. That is important because the biggest factor in this transaction will be, it all comes down to DTI. Debt to income ratio, because everything else has a solution, right? At least that's how we like to look at it here at Elite. With that said, that would be the biggest pro and why people tend to gravitate more towards that loan, mainly because of the fact that you have more room that you can qualify for, right? You can take on a little bit more debt. Your lender will work with you. The next thing is relatively around the down payment. You know, as little as 3.5 down. It's a big go-to for most first-time home buyers, and you can even go as little as 0 down as well with an FHA program. Now, that said, you can also even go as little as 3.5% down with a 1 or 2 to 4 unit property, right? Depending on the lender, you can actually go about that using the 75% rule and use some of the income that you would qualify or that you would get as a rental in that property. If you're living, remember, let me backtrack real quick. So you have to live in one of the units, whether it's a duplex or quadruplex, you have to live in one of the units to be able to utilize that FHA loan for this 3.5 down on one of these multifamily properties, right? Now, the reason a lot of people don't utilize it is mainly because the DTI for a duplex or a triplex, depending on the area, is a lot more expensive, and the DTI is not really in line for all of the debt or income that people need to qualify for a duplex or a quadruplex or a triplex, right? That's a big pro to envision for the future as to really, do I want to go with a single family home, or do I want to look at this as more as an investment to propel me into more future opportunities, right? That said, another thing to also know about the FHA loan is you can do as high as 10% down and not have to take on the MIP or the PMI for the whole life of the loan, right? That is a good thing to know, because a lot of people don't know is that when you do take on an FHA loan, you will have to take on the PMI or the MIP for the life of the loan. We'll touch about that in a second. But yeah, that's great to know, because I mean, if you have the funds to put down 10% and you can get that off your loan, you know, that's great. That said, though, I mean, you're most likely going to end up refinancing, you know, probably within the next 3 to 5 years. But let's say that you don't, you know, you have that security. That said, there's a lot of ways to really amplify the FHA loan, because you can tie it with a 0 down and even an MCC at the same time. For those who don't know what the MCC is, it's a mortgage credit certificate that allows you to get income back at the end of the year for how much interest you make. But that's a whole nother subject that we can touch into if you guys let us know. Now, touching to the cons. When it comes down to FHA, you have to pay what is that MIP or the PMI, right? That MIP or the PMI can range as to the amount of the loan that you are going to be taking on. And it will be, there's 2 variations. So there's going to be a PMI or MIP on your payments, as well as the front end. So there's a back end and a front end. The front end will be added to your loan amount at or before closing, right? all depending on your lender as to when he gets those closing disclosures to you, but typically that's how it goes. And that is important to know because you're going to be paying essentially more for the simple fact that you're going to have to deal with that PMI or MIP, right? Depending on your lender, though, the amount varies. So please take it into consideration talking to your lender to find out how much of a percentage they're taking from the loan amount to add to your MIP or PMI. That said, the next con would be the fact that it has to be an owner-occupied property. You cannot necessarily have an FHA loan and not technically owner-occupied or have it as a primary residence, right? And you can't have more than one FHA loan, and that's something to remember as well, right? That's the downside, right? Another thing to keep in mind is that you can't necessarily waive the full appraisal of your loan. That is always something you're gonna have to deal with. So for those who don't know what the appraisal is, that's when the bank sends out their third-party individual to do an evaluation of the home to make sure that the money that they are loaning you is enough for what you're looking to pay, right? And it makes sense on their end. That said, that's all FHA. Switching now to conventional. With conventional, it can be a little bit easier on the amount of money that you'll have to pay in the grand scheme of things. With conventional, you can go as little as 3% down, and you can even do 0 down as well, depending on the lender that you use and what their DTI income ratio is. Now, that's the thing with conventional is that the DTI is typically more strict. It's more strict in the fact that as to how much you can actually use. So typically, at conventional DTI, lenders want you to be around 43 to 45%, if not less than that sometimes. But that's a good basis to go off of. Now, with conventional, that is where you want to make sure that you also are on point with your credit. And credit is going to be another factor with conventional that is typically more strict than FHA. Going back to FHA, you can have as little as a 500 as a credit score and you can make something work with FHA. Do I recommend it? Not necessarily, but it's there. The opportunity is there. Now with conventional, you want to have minimum from what I've seen is 640 or higher to be able to get a conventional loan. Now this all comes down to which lender you're looking to use. There may be a lender who could do less on the credit score, right? Not every lender can offer you the same product. That said, with conventional, the MIP and the PMI is typically less in the grand scheme of things. You will still have to pay that if you're not putting 20% down, right? With conventional though, once you reach that 20% equity, or you pay 20% off, that PMI or the MIP falls off, right? So that's a huge benefit to conventional compared to FHA. With that said, another thing to take into account is the amount, the conforming limits, right? Is that the correct that's the right term, right? Conforming limits that you can actually use with conventional is typically a lot higher compared to FHA, right? FHA is usually a lot lower because of the fact that this is a more debt sensitive opportunity that you're taking on with the loan, right? Conventional, they'll let you go a higher because you're typically seen as someone who just knows how to cover their finances better and track them better. That said, really with conventional too, another thing is that you can actually waive your full appraisal, right? You don't have to necessarily worry too much as to whether or not the home will appraise. You can go ahead and cover that difference if you wanted to. That said, going back to the grand scheme of things, if you want my personal opinion, I would always try and go conventional if you can, but sometimes the math will actually go better on an FHA depending on what you're looking to buy and how much you're putting down, what the interest rate may be, right? That said, connect with one of us to really get the answers to about which program is the best for you and which way to strategize it. And know that we're here to help. I don't know if we have any questions there.
Can you explain to people what debt to income ratio is?
Yes, so the debt to income ratio, guys, is essentially what the lenders use to verify that your income is higher or a certain percentage of your debts, right? So they compare your income to your debts to make sure that there's a percentage that is not taking up too much from your debts to your income, right? They want to make sure that, hey, if your income is, let's say 100,000, right? You're making 50,000, and you have 50,000 in debt. That's 50%, right? They want to make sure that you're not exceeding more than that 50%, or you're having less. Really, anything less than 50% is good. You want to try and stay as far away from more than 50% as possible. Good rule of thumb is 30% debt, but you know, nowadays it's you know, it's not necessarily the easiest thing to do. I don't know if
I have a question for piggyback right off that. If you have debt that is higher than that, right, but you do pay off, how fast is that? the bank will take that into consideration.
So if you have debt that you have
It's over 50% off, yeah, but you pay it off while you're applying for the loan. Does that automatically comes in effect? Is it a waiting period?
It really depends on the debt.
Okay.
Right? Depending on the debt, that's what's going to really tell you whether or not how fast it'll fall off. That said, though, I would still urge you or suggest that you apply with this lender, because at the end of the day, the lender will be able to give you a basis as to what you need to work on. Because some debts aren't as important as other debts, right? That said, should you still obtain the information, even if you have, you know, that your DTI is a bit high? If you haven't spoken to a lender or a realtor yet, I still highly recommend it, so that way you know what is more important to pay off or not to pay off. But essentially, yes, I mean, you should still, you know, speak with an expert about it.
Okay, makes sense. Thank you. Okay, we don't have any more questions.
Great. Okay. Well, guys, remember that, again, Daniel Gonzalez here with Elite Realty. We're here to help find the solution for any situation you guys may be in, or help you strategize your portfolio and scaling your portfolio, right? That's what it's all about. I appreciate you guys for your patience and watching me go through these lives. You know, it's a lot of improving that we're doing each and every day. And thank you to Elite and the team. And thank you guys for stopping by. May you guys have a wonderful Friday. Please don't forget to contact us via the phone. My phone number is 512-590-0740. And thank you guys for stopping by.
Thank you. Woo!